We are in a transitionary period, linking the past of the awareness of gold, the anthropology of gold, and the future of really human interaction with technology. These two periods of human history are being linked, the past and the future, through Bitcoin. Bitcoin is a digital representation of the human anthropological magnetism toward gold. And Satoshi Nakamoto knew this. That's why he called it, or he described Bitcoin security as similar to how energy is expended to mine gold. This was in the original writing about Bitcoin.
Welcome back, everyone. Today it's episode 35 of the Store of Bitcoin podcast. We're recording on September 8th, right around block height 913,800. Today we're thrilled to be joined by Nick Bhatia. Nick began his journey with getting bachelor degree business administration from USC, followed by his master's in finance from business school in Madrid. He built a strong foundation in traditional finance as a fixed income trader and an interest rate strategist, including time on the US Treasury desk for a large institutional asset manager, where he gained extensive experience in money markets and interest rate futures. His pivot into Bitcoin came prominently in 2021 with the publication of his #1 best-selling book, Layered Money, which masterfully traces the evolution of monetary systems and introduces key frameworks for understanding money and Bitcoin. Fast forward to today, and Nick is the founder of the Bitcoin Layer, a research platform delivering insightful macroeconomic analysis of Bitcoin and its place in the global financial ecosystem. He's also adjunct professor of finance at USC Marshall, where he teaches courses on fixed income securities and Bitcoin. Nick is a CFA and CMT charter holder, and he has coined concepts like layered money that have influenced countless enthusiasts and professionals. In 2025, he followed up with his latest book, Bitcoin Age, diving deeper into money's transformation in the digital era. Nick, thank you so much for joining us.
Johan, thank you for having me. It's a pleasure.
All right. And of course, a warm welcome, as always, to our own Alessandro and Francesco.
Hi, Johan. Hi, Nick. Looking forward for the conversation. Great to have Nick as a guest.
So, Alessandro, I'll pass it up to you first.
Yes. Nick, first question from my side is related on your latest recent book, Bitcoin Age. I also recommend every listener to read it. In your book, Bitcoin Age, you have described this Bitcoin age as a new monetary epoch. How do you define this age? And what markers will tell us we have fully entered this age?
It's a great question. I think it comes down to a consciousness. So my book, Layered Money, published in 2021, I believe the reason that it resonated was people already understood Bitcoin to be a first layer, non-counterparty money. And that is the age in which we live now, is that every single person in the world has access to non-counterparty global money. You can think all you want that your gold coin in your pocket is first layer non-counterparty global money. That's fine. And gold's market cap to Bitcoin is still one order of magnitude greater. Those all are correct. However, we are in a transitionary period, linking the past of the awareness of gold, the anthropology of gold, and the future of really human interaction with technology. These two periods of human history are being linked, the past and the future, through Bitcoin. Bitcoin is a digital representation of the human anthropological magnetism toward gold. And Satoshi Nakamoto knew this. That's why he called it, or he described Bitcoin security as similar to how energy is expended to mine gold. This was in the original writing about Bitcoin. So I believe that Satoshi Nakamoto is the creator of course, the Bitcoin age. And that creation, the awareness caught on, I believe, in around 2016. And we can debate it, all we want, which year you want to say the Bitcoin age began. But I really believe that we are about almost a decade into a Bitcoin age at this point.
Okay. And how do you foresee going forward? Will be firstly a store of value, then people will start to transact at a global scale, and then will become a unit of account in the next years?
I believe that all of these coexist, and you might see more transactions on a global scale in the future than you do today. But adoption happens in all of these ways. There are entities, people, families, and entities that are accounting in Bitcoin, companies and countries that are transacting in Bitcoin, and people that are storing value in Bitcoin. So I believe they all come together. Bitcoin is incredible because it is an accounting system, a transaction network, and a store of value, all from its own code base. That doesn't take any private sector entity to come and make it that. Now, we definitely had researchers and private sector actors that have brought on the Lightning Network. And so Bitcoin has components of a private sector solution to its underlying protocol. But I do believe they all come together, and it's not a sequential process.
Okay. And for this, thanks for the answer. On this awareness, make me think a recent interview and podcast I listened with Chris Kuiper, that is vice president for an institutional company. And he was saying one of the problems for institution to be awareness is like asking a fish about the water. How is the water? And the reply is, what is the water? Because they never questioned it. The same financial world, probably they studied bonds, stocks, US market, cut rates, the impact, but they never question what is money. When do you think this will happen at the institutional level? We see already the beginning of it.
Yes, this is a good question. The this is a great analogy, actually. The world in which we live is this banking system. And that's something I wanted to describe in my book, Bitcoin Age, is that the US dollar is more appropriately described as a global banking dollar. So it's very hard for the world to step out of the global banking dollar and observe it from the outside. That's actually what Bitcoiners do. It's a very unique perspective that you have to step outside of the global banking dollar into the real world and observe the global banking dollar as a system. And I think it's important to understand how powerful and emergent and lasting that system is and will be. I think that's very important to do. I think people that observe the system and think it's going to collapse are missing out how embedded it is in our society. Doesn't mean it can never collapse, but that collapse is not within the realm of probability, for me at least, in the short term. So your question is, when will the system start to teach or think in these terms? I don't know if they do. And I think that they're describing Bitcoin as a good investment, not, hey, step out of this system, buy Bitcoin, and then observe the system through this new lens of money and Bitcoin separated out, where money is just what you use to describe the current banking dollar system and Bitcoin is a separate system. So I don't even think they're ever going to advocate for that because they want you in the system to buy IBIT, right? So that's the way I see it. I'm doing my best to educate through my own framework, but I don't know how mainstream the way I teach it is or necessarily ever will be. And that's okay.
It's how new technology advance. They're still very early. Yes. Thanks for the reply. Johan or Francesco, you have something to add on this question?
No, but for later on, Nick, I want to go into what's happening now at the bond market. But before we go there, maybe as a primer, could you explain what the evolution has been of the reserve assets that back different kind of monies, like you did in layered money? Because I think we'll touch on it later, but I think when yields go down or when the Federal Reserve lowers the funding rate, and like the first order effect is that borrowing money gets cheaper, but there are second order effects that taps into liquidity. But before people can understand that, I think maybe you want to take them with you in the whole concept of like, yeah, what's money backed by? Where was it backed by in the history of money? And where is it backed by now?
Okay, I'll try to do the super short version here. People understand that gold is historical money. The reason that they understand that is because they've learned stories from the time that they were born, essentially, that both in fairy tales and ancient history, and even Harry Potter, if you want to throw it in, with their Gringotts bankers, gold is understood across fiction, nonfiction history. It's because there is a chemical component to Bitcoin. To gold. There's a chemical component to gold that is unique and is inherent in its position on the periodic table of elements. So it's chemical in nature. And the attraction of humans to gold or to that chemical is ancient and almost part of our DNA as human civilization. This is evidenced by, I think, really well by the European conquest of the Americas in the 15th and the 16th centuries, in which the natives in the Americas understood that gold and silver were powerful. And then the Europeans, when they arrived, used these metals or access to these metals as the reason to come in and conquest and kill and seize. So even though the way that the Americans, the Native Americans and the Europeans treated gold and silver was different 600 years ago, it was still very human on each side. There was a value there and a respect and a relationship. So saying that, hey, I will hold your gold for a couple weeks and I'll give you a piece of paper that says, I promise to pay you back the gold. That piece of paper over the course of the 12th to the 15th, 16th century, that piece of paper also became money. And sometimes it wasn't even a paper, but a double entry book account where you write it down that say you owe me, and I write it down that says I owe you. And that promise itself has value. So that's very similar to a deposit, bank deposit today. You don't even really carry, people usually do not carry around their current balance on a deposit slip on a piece of paper in their pocket. And even if they did, could they give that to a storekeeper and use it as money? No, but it's money to that person. So in this way, both paper, actual pieces of paper that say I owe you gold, or just a book entry that says I owe you gold, that's layered gold. It's not gold, but it is a promise to pay gold, whether directly or you could just use it as cash. And that's layered money. Is that the paper is as good as gold because the promise is good. The promise has risk, but over time, once it comes from the US government, how much risk does it really have? And that was the financial system's basis for currency for so long, meaning that currency was money because currency was layered gold. But since 1971, currency is no longer layered gold. Currency is now layered bank notes, bank reserves, and government debt. And government debt, yes, today it satisfies this role that gold once did as this really good collateral. We'll get into treasuries and their specific role. But the global banking dollar system today is it's layered credit. It's layered promises. And the underlying denomination, which used to be currency that's payable in gold, it used to be layered gold. The underlying denomination is just bank credit. It's just promises. And to a certain extent, the government's promise, but the government's promise doesn't keep the currency stable because banks are in control of the currency. It's all bank credit. So today we live in a layered credit system with gold not a part of it at all. It singles out the credit of the US government as today's pristine collateral. What it backs the US government debt is separate, like that's a separate question and answer. But for now, layered gold became layered credit, and the purest form of credit is US government credit, but the US government does not control that system. It is a banking system. It's a credit system. Therefore, it's the banks that operate it. And I would suggest very strongly that the central banks are part of the control of that credit system. That's why their independence, I put it in air quotes, independence from governments is relevant in that the central bank can get away with acting on behalf of banks at times when it's advantageous to the banks, and then it will act on behalf of governments when it's advantageous to the government. And it really does do both.
Francesco, you're on mute.
So if I may on this point, it's like the fiat system is linked to some form of yield. I know we have a past also as a fixed income person involved in this kind of activities. And that's what you're selling. All of the risk is framed in what so-called market, which sells risk and buy and sell risk. And maybe before, centuries ago, which was much easier, you had just had the gold coin, take it or leave it. So now we have all of this ecosystem which sells to the people something. And on the other hand, we have the Austrian economic system, Bitcoin, which has no yield. So it has the power of deflation. Now, so how do you see the fixed income narrative? I mean, not called a narrative, the way of financial instrument, you know, the way for the people to get some money, and how would this the interplay between the two different worlds this is going to exist or anymore, and more importantly, the deflation, how does it affect the bond market in the transition between fiat standard to gold standard? Because if I look at it nowadays, I can see the inversion of the yield curve, which could be a mirror of deflation. And also, the rates are almost the same, 4%, 3 months, 4%, 10 years. And that's still very strange. It has been like that for 3 years so far, but it wasn't like that before. Is that a sign there is a crack, that something is not running very well in the fiat system, and that there is a replacement happening thanks to Bitcoin? And what role does a fixed income can have for an investor? Also for a Bitcoin order, going forward, if this transition is keeping going to happen?
I think that Bitcoin and fixed income are still in very separate segments of the global financial system. I don't think that there's a lot of signal that we can take from the fixed income market that tells us something about Bitcoin. For example, I don't believe this. You're talking about a flat yield curve between bills and 10-year notes. I don't think there's anything in there that tells us something about Bitcoin's effect on the current system. With that being said, the yields in the fiat system today have gone through a big shock and then a normalization over the last 5 years. So where are they settling to now versus where were they during the 2010s? Well, they've settled a little bit higher. And I think that is a sign that there's more inflation built in on a semi-permanent basis over the next 10 to 30 years in the expectations. Will Bitcoin trigger more of a deflationary system? I'm making the argument in the book that technology is always going to be deflationary force on the economy, but deflation ends up in debt defaults, which ends up in credit write-downs, which ends up in bank failures. So the process to get that goes through the power structure of banks and central banks agreeing to let yields fall, far below their inflation targets and allow credit destruction. But it's in their mandate to avoid deflation. So that's why anytime yields and growth and inflation expectations start to fall, they'll come in to ease policy and stoke borrowing once again, or to what is called extend and pretend, where you paper over bad debts and let the central bank absorb them so that the market doesn't have to absorb losses. So I hope that some of that answers your questions about my outlook, but I think it's risky to look at the fixed income market and say Bitcoin is doing that to that market. The size of the fixed income market is 2 orders of magnitude larger than Bitcoin. So the two are they're not playing in the same arena, in my opinion. And Bitcoin capital is more akin to fringe equity capital that's finding its way into this asset class as a growth tool, as opposed to a gold replacement or even a fixed income replacement.
No, it's clear, but the fact that there is semi-permanent inflation stored in the bond yield, that's also telling. I mean, that's why they keep behaving differently in the last years, because there is some inflation which doesn't go away and is still there in the bond market. Interesting, was something new I never heard before. So thank you for that. Any questions?
So first, before I want to pass it on to Alessandro, I want to get back to the layered money, because after I read your book, Nick, I came to understand that when banks are about to fail, people take out cash. But then after reading your book, I realized they go up a layer with cash, because cash is like a commercial bank is just something between, because cash is given by the central bank, so it's basically a layer 2 money, and a commercial bank comes beneath that, and having a checking account with a commercial bank, that's layer 3. And I always thought, because that's like physics and you can save it, but I realized that you really go up a layer, and even if you buy US treasuries, you go up a layer again, and you're really holding the reserve asset that banks also have on their balance sheet. So, I mean, that was such an epiphany for me. Everything made more sense. So thank you for...
Given that we are on this point, what do you think about the treasury companies? Now we are seeing an enlargement of the MNAV versus share price. But yeah, that was cyclical. Do you think this company, the fact that they allow more trading of options, creating big volume, so therefore they can borrow more money based on that volume, is that a catastrophic flywheel or does it make some sense in the Bitcoin economy or not at all? It's just a fiat invention, reiteration of the same problematic behavior in the past.
You ask it in a way where I can't just take the easy answer. So let me answer the last part about behaviorally and, will it create a bubble and bring, froth into the market and then bust? And is it just another example of that? I would say to some degree, yes. I mean, in any bull bear cycle, you get greed, fear. And that is a tale that market analysts must understand. You must understand greed and fear always. And if you understand valuation, balancing between greed and fear becomes a little bit easier. So how do you value Bitcoin is a separate topic here, but seeing froth come into the market and seeing people risk capital at multiples of what the equivalent Bitcoin, you refer to it as MNAV, but we don't even have to say that. We can just say dollar for dollar, how much are you paying for the Bitcoin? And if you're overpaying for it, then you have signs of froth in the market. And do I believe that Bitcoin treasury companies might be one of the avenues in this current cycle that brings froth to the market? Absolutely. Sure. And it already definitely, feels like that. But with all that being said, let me just say my original response when you started asking the question, which is, what do I think about these companies coming in? To oversimplify, it's just a natural development in this adoption path of Bitcoin, which I'm thinking that the full adoption of Bitcoin around the world takes about 40 years. By the time you hit 30, it's kind of everywhere. And by the time it hits 40, it's, at what the internet is today. Right? So the internet in 1970s kicked off and then really, started to go private with, let's say, Sun Microsystems in the 80s. When Sun Microsystems put internet capability on every computer. So 40 years for the internet, 40 years for Bitcoin. So in year 16, do you expect companies to pop up where their entire business model revolves around creative leverage of Bitcoin? It makes a lot of sense from that perspective. And it makes a lot of sense. It comes right after IBIT, second mention of IBIT today. And it comes right after Abu Dhabi. I'm blanking on some of the large, even if you want to talk about the Ethiopian hydroelectric facility, largest hydro facility on the continent of Africa, and the government is using excess hydropower to mine Bitcoin, then why wouldn't some California entrepreneurs get together and come up with some good convertible note structure that gives leverage to invest, the equity investors over raw Bitcoin returns? Johan has pointed out fantastically that you do have to have an exit plan and a runway and the eventual conversion of those Bitcoin holdings into income in some way. I think Johan is actually quite on the cutting edge of how to achieve longevity for these companies. So I would almost defer to him there on how they should achieve and can achieve longevity. But very natural, Francesco, at this point in Bitcoin's adoption cycle. And is this the thing that brings this version of bubbles? Sure, it might be. You think about how stupid ICOs were. And then you think about how stupid the Bored Ape stuff was. The level of stupidity of the JPEGs was beyond the ICO, because at least that was them trying to rebrand IPOs without the actual counterparty obligation of returns. You think about the level of stupidity, at each level of each bubble, and who knows what people will be marketing and what they are even marketing today in terms of trying to get your capital to buy their shares instead of Bitcoin. So that's why we focus at TBL on strategy. For example, Johan is, becoming an expert in their capital structure so that we can really think about the big player, how they're approaching it. And he's not, looking through the latest 10 filings and being like, this is the one, this is the pick'em, this is the hot one to go through, because stock picker. That, then that tells you where we are in the cycle. If we're trying to go that extra mile to find the 1 in 10 Bitcoin treasury company that could achieve longevity. So that would be my answer to the BTC TC question.
All right, Alessandro, you take it.
Yes, firstly, one comment. I agree with you, Nick, on the develop from ICO, JPEG, and now Bitcoin treasury companies that are more in Bitcoin. It also support this for psychology. Many humans, they feel to do something, and buy and hold sounds easy, but it's not. And people think, it's too boring, too simple, and that's it. It's not smart enough, so I need to do something. So at least we have now companies in Bitcoin versus other uses of blockchain or a JPEG that of an ape. So completely different, and it's channeling this feeling of doing something towards Bitcoin. On the point that you made, the question before for gold, US treasury bonds, and the interest rate, two questions. Firstly, as you said, the Fed has the mandate not only to avoid deflation, but also to keep inflation at 2%. We have seen now last month, first time that Powell said in a sophisticated way that the 2% is not as important as before. And now we have expected the CPI at 2.9%. They should come on Thursday, will be around that level. And the interest rate, according to consensus, will drop maybe 25, 50 basis points in September, 25, let's say, and anyhow 100, 125 in the next 12 months. So it will be clearer and clearer that the 2% inflation cannot be kept. Do you think we are approaching the time where the Fed has to say, and they will find very sophisticated way to say that we have to adjust the target, but the target of 2% will be abandoned, or they will find a way to keep the 2% as a target?
So let's answer this in two parts. We'll talk about real versus nominal rates, and then we'll talk about Fed versus the market. So yields today, 10-year treasuries, 4.05%. Okay, 4% on 10-year notes is the nominal yield. It means that is what you get when you buy the instrument. You are going to get a coupon that is 4.05 divided by 2 twice a year. Baked into that 4%, baked into it is your expectation of inflation and growth in the future, plus a compensation. That is the theoretical makeup of the 4%. Now, how much of that 4% do you feel is you being compensated for inflation in the future, and how much of it is the kicker? That is only for you to say. Now, the market has a way to measure this. I'll get to that in a second. But in reality, in theory, when you get that 4% every year, you get that 4% knowing that on day one, you made an investment to get 4% fixed on your money because you thought it compensated you for whatever you would need to make that investment. That's what fixed income is. Now, in the treasury market, we have Treasury inflation protected securities, TIPS. These are market instruments where the yield on them, it's called the real yield. The yield on that instrument, when you buy the bond today, you get that real yield plus the CPI calculation that every 6 months that they make around the time of
whatever is the CPI,
whatever it is. So it's essentially a floating yield. It's a fixed component plus a floating component. Now, if we look at the market today, the TIPS yield is, let's just round it to 2%. The TIPS yield is at 2%, and the the nominal yield is at 4%. So the real yield is 2 and the nominal yield is 4. What it means is that the market thinks that over the next 10 years, those two are equal to each other, which means the market thinks they'll get 2 plus 2, 2 plus 2, 2 plus 2. And that's why that's the break even, it's called the break even inflation yield, because it's what makes the real yield and the nominal yield equal today in the market. If they weren't equal, there would be an arbitrage. Because if you thought inflation was going to be at 7% next year, you would buy the tips. You would buy tips because you would get 2 plus 7 next year, not 2 plus 2. So the market would arbitrage it away. Okay, so where have real yields gone over the last few years? They've gone much higher. They used to be 0 or negative. Now they're much closer to 2. It means that to buy treasuries, the Treasury Department is having to pay up more. That's all it means. It means that the penalty that they have to compensate for that kicker that we talked about. They're not only having to pay inflation, they're having to pay inflation plus the kicker. So you can think of it as theoretical, what the inflation is going forward, or you can think of it as a break-even calculation between tips and nominal yields. But either way, the inflation expectation going forward is somewhere between 4%. It's not 5. And it's honestly, it's not 4 either, because I don't believe that real yields are 0. I believe the market, so I believe they're around 2%. So therefore, I believe inflation expectations are 2%. But even devil's advocate, no, actually, inflation expectations going forward are 3%. So I believe the real yield is only 1. Either way, it's not more than 4, because that's the nominal yield. So that's my take on inflation. Now, my take on the Fed is that the Fed doesn't matter. What matters is the market. So the 2-year yield is 3.5%. The 10-year yield is 4%. The 3-month yield is 3 3/4. It's a little wonky of a yield curve. It's inverted between bills and 5s, and then it steepens back out, or 3s and steepens back out. But the Fed itself is just playing catch up to the time value of money, which is the compensation for inflation. And right now, 2-year yields suggest that the Fed will cut another 75 basis points or so over the next year. So that's what I go with, and I watch the price action in the 2-year yield to tell me where the Fed is going. I mean, it was pretty obvious that a few months ago, the Fed was priced in to cut. So it allows me to avoid all articles about the Fed for the last month or two, because I don't have to read them, because the market already told me that we are demanding less compensation for our money. 10-year yields have come down from 4.5% to 4%. It means that growth and inflation expectations are coming down. Your original question was about the 2%. One of the parts was about the 2% target. Yeah, the Fed might have abandoned it, but yields have been above 4 in most of the curve for 3 years now. So the market was already demanding way more than 2 on a nominal basis, and still somewhere between 2 and 3 on an inflation break-even basis. So I'm sorry to get so into the details on the fixed income market structure, but it's important. It's important when we talk about the Fed's 2% mandate.
Thanks for the reply. Yes, detailed reply. I think definitely it helps to properly understand. They're not easy topics. So thanks for the.
So we should not be surprised, at least. And because the market always in control, then also all the speculation, the Fed always catching up. It means that there's no way they cannot catch up. They have to, because if the market is always adding, what can they do? And yes, I mean, not to justify that. I just want to take a couple of seconds to tell to our listener that this podcast is sponsored by Bitvault. Bitvault is the first wallet solution to solve the problem of physical attack and hacks. Thanks to our breakthrough time delay over multi-sig technology. I invite you to head over to our website, bitvault.sv, like here, beside my name. And you can get the offer of just under $99 forever for a lifetime discount, launching next month in October. Thank you very much. Any other question?
Yeah, so Nick, I want to, because I think it's such an important topic, and I know the Bitcoin layer it's basically becoming TBL is becoming specialized in this topic. It's about liquidity, and you all already gave the primer of like reserve assets, and this is also something I learned. I learned it from you, and also it makes so much sense. So I really want to have the listeners to have the same experience as me. That it made so much sense that when I learned from you that banks have those treasuries as collateral, and when the yields go down, the value of the bonds go up, which makes them more, or have more. How do I say that?
Firepower.
Yeah, more fire. So please, would you explain a bit more about collateral, liquidity, and the US treasuries in those banking systems?
Today, most lending and borrowing is collateral based. So the vanilla way to think about this is a home loan in which you pledge your home to the bank and the bank lends you money. If you don't pay the bank back, the bank gets to take your home. That's collateralized lending. In the banking system, it works with treasuries. So if you can prove that you have treasuries, you can borrow against it. And that's how a lot of financing is done today, especially in the wholesale corner of the market where banks are basically trafficking in treasuries in order to free up cash so they can go leverage it and do other things. The key here is that if you can secure treasuries as your base asset, you can transform that treasury, mostly about 97%, into cash, and then go take that cash and invest in other instruments. You get the economics of the treasury security, meaning you get the yield from it. You have to pay the borrow on your loan, but then you get to secure yield on whatever you invested that 97% with. So treasuries are the easiest way to leverage in the financial system. You get that base interest rate, and then you get to reinvest the money, 97% of it. That's transformation of collateral into cash, which then can be used to invest in risk. And the reason that you can borrow 97% against your treasury is that it does not come with default risk. You are always nominally good. And in that way, it is as shiny as a gold coin in the financial industry. Even the bonds of Apple Computer, which nobody believes are going to default over a 10-year time horizon, for example, would receive 40% versus 97%. You can still borrow $40 on $100 of Apple bonds, and maybe this or that hedge fund might be willing to lend you more, but you are not going to be able to come close to that 97% amount that treasuries allow you to access. So Johan's question is about what happens when rates go down. When rates go down, all the treasury prices go up. So the balance sheets of any entity that owns treasuries get stronger overnight. And that allows them to then go out and borrow more money against the new mark-to-market price of their treasuries, and then use that money to go and buy risk assets. So when rates go down, collateral gets more valuable, and the increased value can then be extracted and levered up in the system.
Yeah, that's a perfect summary. And if the way I think of it is like the yield, when the yield goes down, it becomes cheaper for people or businesses to lend money. But the asset side story is more about, so the one is about the costs, so the first order effect, and the second order effect is about the availability of liquidity in the system. Because if rates goes up and collateral goes down, the availability of liquidity goes down also, and that's what Michael Howell and the Bitcoin layer now is very on top of it. So
And
I think
it's different. It's difficult to even say which one is the first order of effect. That's what I find so fascinating, is because yes, rates go down, so it becomes cheaper to borrow. So the demand for credit is more willing to step in, but the supply of credit also has to be there. So which one is first, or are they happening at the same time? It's not an easy question to answer.
yeah. So I'm sorry, maybe I'm using the wrong words, but what I basically mean is that if I talk about this topic with friends or family, they all intuitively know that when yields go down, it's going to be cheaper to lend money. But the second part about the collateral, that most people don't know about it. So thank you for explaining. Alessandro, do you have another question for Nick?
Yes, my last question for today will be on when Bitcoin reaches 25, 30 trillion, let's say. And now gold is 24, almost 25. It reached all-time high. Bitcoin is small, as we were saying before, 2.3 trillion. And the global bond market is 2 orders of magnitude, so around 300 trillion. Once Bitcoin is around, let's say, 30 trillion, what do you think will happen to gold? Will increase together with Bitcoin, or Bitcoin will suck more than what gold will increase, a part of Bitcoin? And at this point, there will be competition with the global bond market, because I expect a 30 trillion, 5,000 years that gold is the most valuable asset. Once it becomes Bitcoin, it's not once in a generation, once in a species event. Maybe now there will be the time that this 60-40 portfolio will be questioned and Bitcoin will compete with the global bond market. What do you think?
It's a very interesting topic. I do think that gold will grow over that time horizon. I don't have an expectation of, when Bitcoin catches gold, what will gold be at that point? I don't have a great estimate of that, but I do believe that as Bitcoin grows to that level, gold will still be growing. The reason I believe that is that I believe the credit system persists and gives the reason to hold more collateral, better collateral over time. At that point, does it more threaten or compete with fixed income? Yes. But does real estate today compete with fixed income? I would argue that it does. That the two are different. They're different asset classes, but they're both offering yield and both require a certain amount of time to invest. So all asset classes are always competing with each other. And that intersection of Bitcoin, especially when you get to a point where owning Bitcoin itself can be accretive, again, back to these treasury companies and what they can do. And then Bitcoin itself might have good investments that produce yield. And then they will challenge fixed income assets more. But fixed income and real estate, the reason these asset classes are so big and popular is that people need that yield to live off of. That's their income. So one day, yes, the two start to intersect more, but maybe not for some time.
But one short comment on this. But if Bitcoin gives now 60-80% a year, it's not anyhow better than giving fixed income in case we sell a small portion of Bitcoin, but overall it grows more.
Well, absolutely. I mean, that's why it's the superior investment, but you still have to think about market segmentation, such as a life insurance company. Why do they own 30-year bonds? Because their liabilities happen when their clients die in 30 years. There's no other reason that they hold it. They are asset liability matching. And that's one particular way to understand market segmentation. there's demand for asset classes because there is built-in demand in different segments throughout the world.
Okay, got it. Thanks.
Yeah, so the 6 minutes are almost up. I don't know. Francesco, do you have one last question for Nick?
Yes. What's the added value you see in the markets aside from the pure monetary market value of Bitcoin? Talking about emerging markets where in a crisis like a bond crisis, the court control, they will start to flight capital, so to be less an edge against forex problems between one currency and another, and the borderless feature of Bitcoin. Because the world is very big, some countries have already experienced all this situation. Some will experience, most likely, thinking about maybe even Japan and also some European countries, sadly. But is it possible to think about that this feature will have a price, and in the next 5 years, let's say?
Well, I think about the cost of living increases and how that attracts people to Bitcoin. I think that that's really one of the easiest ways to think about Bitcoin's potential for people around the world is that hedge against cost of living. And that becomes most dramatic in places that, we just might not be able to see because they happen in countries that are not necessarily our neighbors, but further away. So that's how I'm thinking about it.
Yes, but also in a situation where the government starts to be predatory and start enforcing illegal control. Everybody would like to move their money, but if it's the banking system, they cannot. Bitcoin, they can. So it's not that delusional to think that maybe in some country this will happen again, like it happened also in the past. It can be also country not really the developing one, maybe also a bit better one. But after this cycle, when there will be too much money printed, then things can really, I don't know, the bond auction sale cannot be covered fully, so things can start to go south, and maybe there is some other value in the intrinsic value of Bitcoin also for this borderless. I don't know, is there?
Yeah, I think that global instability and these black swan events that you can't see, corrupt politicians, banking collapse, these are all imminent threats, and they're very important to understand for the why Bitcoin. It's not commonly thought of in some of the major economies.
So thank you, Nick. Yeah, let's wrap it up here. Where can people find you on the internet?
Everything that we're doing is at thebitcoinlayer.com. We put out really great free content on YouTube and on audio in your favorite podcast app. But also, of course, for those that are looking for that next level of research, you can become a TBL Pro. So everything is available at thebitcoinlayer.com.
Yeah, that's great. And don't forget to buy Nick book, Layered Money and Bitcoin Aid. So thank you, Nick. Thank you for making time to come on and to teach us and our listeners.
It's my pleasure. Thank you guys for having me.